Welcome to Make Your Money Matter, the show that aims to change the way we think about financial advice so you can make better financial decisions. Brad Barrett is a managing director and partner at One Capital Management, a wealth management firm serving nearly 1,500 clients nationwide with over $2.5 billion in assets. They are a group of advisors dedicated to ensuring their clients achieve their investment and retirement goals. And now, here's your host, Brad Barrett.
Welcome to Make Your Money Matter, the show dedicated to helping you create a better relationship with your money. I'm your host, Brad Barrett, and it's my goal to help distill the best ideas when it comes to your finances so that you can make more confident money moves. Here at One Capital Management, our mission is simple: to help our clients and you listeners take control of your finances and build the life you deserve. Friends, today the challenge is no longer the access to information, but rather it's finding the right information. And more importantly, how all that information applies to you. And that's my commitment to you here each and every week, because after all, your money matters. And before we get started on this week's episode, to find out more about myself or our firm here at One Capital Management, you can go to our website at onecapitalmanagement.com or give us a call, 805-409-8150. And you know, they say the truth is the first casualty of war. So here we are, a little over a week into the Russian invasion of Ukraine, and the fog of war is still very thick. I think we all can agree with that. And as I've been speaking about in the past 2 episodes, essentially, you know, over the past few weeks, it's been conventional wisdom, I guess, that Russia would take parts of Ukraine, maybe all, and then things would settle down while the world awaited further actions. And in the worst case scenario, to many, those moves could include closing the current 40-mile wide border between Poland and Lithuania, which could all lead to direct NATO military involvement and a wider conflict. Now, so far, things haven't unfolded as many thought they would. Supply chain issues, obviously, for the Russian military and the formidable opposition are all slowing Russia's advance. It's amazing to see, especially to what many would say, and myself included, the morality of this war, this invasion, is just wrong. So I do believe that in the story of David and Goliath, God is on David's side here with Ukraine. Now, in addition to all this, the more sanctions and military help that have come from basically countries around the world, including the US, have given a lot of hope that hostilities end somewhat early, with Russia failing, hopefully, well short of its goals of taking over Ukraine. And if Russia is unable to take control of Ukraine, and we're going to talk about this as it relates to this week's subject matter, if Russia is unable to take control of Ukraine or even forced to retreat, that would be amazing, Vladimir Putin could be in more than just political trouble. His inner circle may not like risking access to their personal wealth on what they might believe is an ill-advised military adventure in the beginning, in the first place. So for Putin, this is a huge incentive to continue his attack and escalate, which is bad for everyone. Nothing is totally clear here. And as fate would have it, about a week into this invasion, we also have our first State of the Union by President Biden. And I want to touch on this a little bit because that's a lot to do with things of our economy and the world economy, rather, around inflation, interest rates, social and economic situations. And I want to combine the two here as we look forward into this week, talking about some questions I think everyone should be asking around money right now, largely on the dovetail of what we talked about last week on the show around the 6 reasons why we want to look long-term and stay invested through volatility. And what I personally become more confident with about this conflict is what it means for public policy. And here's what I mean by that. Policies designed to suppress U.S. energy production are going to be tougher, I think, for the voting public to digest. The same is true for many European countries, with basically Germany, as we kind of saw a few days ago, now discussing building a natural gas reserve. And then there's the green energy. Oh, the AOC green energy situation. Many will keep pushing it, like her and others, and those projects will continue, but it's going to be really tough, in my opinion, to curtail drilling and extraction and pipelines for old-fashioned fossil fuels. By the way, and this now goes definitely into the conversation around the State of the Union, and by no means in the first 5 or 10 minutes of this week's episode do I want it to be political. There's just a lot of things going on, both domestically and geopolitically around the world, that are very interesting to talk about as we look at our money and we look at the economy here. The Build Back Better, President Biden's plan to raise spending and taxes for the next decade, it looks even less likely to me when I heard that than before. War means disruption, and many will argue we should wait and see how the economy reacts to the conflict. And in addition to this, while the war will likely make global supply chain issues even more problematic, something we're looking at, and inflationary, the Federal Reserve is likely to pull back on tightening plans because of the potential economic upheaval. We saw that on Wednesday of last week when Jerome Powell got on the stand basically saying that he is looking at what he called a soft landing and looking at a rate hike of around 25 basis points, maybe even 50, depending on where it goes the next few weeks in March, which obviously the market likes and we are a fan of. When the central bank is able to do two main things in a low interest rate environment, to raise rates, to stave off the inflation that we're seeing, but also able to taper or lessen the amount of bonds they are buying on the open market, we're going to start tightening a very loose policy we've had for 2 years. These are good things. Now, while not related to Ukraine, but has a lot to do with the State of the Union, I also want to touch on one thing. The Supreme Court's decision, the recent decision, slapping down basically private sector vaccine mandates by OSHA. This is, again, speculative for me, but I just want to bring it up because it's interesting as we talk about opening up the economy. I think it's a sign that it's willing to limit the power of bureaucrats, which I'm only bringing that up because that may be good news for growth. Not political, just looking at it from a macroeconomic perspective and just putting an opinion on it as I was going through this last week of writing the show and talking with a lot of clients around the conflict in Russia and Ukraine, hearing President Biden talk last week at the State of the Union and putting it all together, the prospects for, staying in the political camp for a second, the prospects for more bills that expand government, I think are going to be waning a little bit, while the court seems to be more wary of regulatory expansions, which again is a good thing for growth. We saw that in the Reagan years with expansion, less government, more growth. Now, while war, I want to say very clearly on this and to put a bow on the conversation around the Russia-Ukraine as we dive into this week's conversation, while war is hell and all of our prayers, and mine for sure, are with Ukrainians, the direction of policy is moving toward the better, and this may be an interesting outlook for that. And as we basically dissect the past week or two, and I've been writing a lot of the content around stuff we've been talking about with clients, some of the fears and anxieties we all have when you see a conflict like this, even if it is going on miles and miles away from us, the ability for it to spill over is still of concern. The ability for us to be drawn into it is still of concern. And so when we talk about this as it relates to our portfolio, our retirement, our overall planning, I want to pick up on a couple things we talked about last week. And if you didn't get a chance to listen to the 6 reasons to stay invested and to look at the long term when it comes to your money and investing as it relates to conflicts and wars, I want to talk about 5 important questions in general to ask around money. Now, when it comes down to the basics of this, there are only a few things you need to know about money: how to make it, how to keep it, and how to grow it. Now, obviously, within those 3 camps, a lot happens, and a lot of it's topical. We've been talking about it. I mean, the first 8 weeks or so of this year, a lot has happened. We've had market volatility. We've had a conflict in war. We've had discussions from the Fed around rate hikes. We've had inflationary items and supply chain issues spilling over from last year. We've had a State of the Union. A lot has happened in these first 2 years. And I know I may be oversimplifying the statement of how to make it, how to keep it, and how to grow it. But most people don't even know the basic stuff. And I think it's really important as we talk about this. And I am very open about this. It's okay. If you're listening right now, and you're like, I don't know how to make it. I don't know how to keep it. And I don't know how to grow it. I may know how to understand some of those things, but I was never taught it. And I mentioned this before. In high school, you weren't taught what a mortgage was. You weren't taught, if you were taught about a mortgage or discussed a mortgage at all with any economic teacher maybe, you weren't taught how to fill out the HUD-1 form or what the process is for a real estate agent on the buy or sell side, as an example. We weren't taught these things. A large part in my nearly 20 years of being in the financial services industry has been around education, because I myself had to realize early on as a young kid what it was that I needed to learn about money to make sure I protected myself. Many have heard my story, but when I was 16 years old, my dad's company went bankrupt. And we had to basically reset our entire life. And it was really scary at the same time for him. For us, we were kids, so he shielded a lot of it. But I saw the evil, the bad side of someone taking a company. It wasn't him, his boss, the CEO of the company, decided to just be a bad person, essentially. And the entire company suffered. Thousands of people, my dad included. It was shocking to all of us. And I remember right there, I made a decision to do two things. One, I was going to learn everything I possibly could about money. And two, I wanted to help people. I wanted to do that for others. And that's why you're listening to me today. That's why 20 years later, this is what we're doing. And so these 5 questions I'm going to bring up may seem very simple, but they're kind of bedrock, foundational items to go through. And in doing this, there was a quiz I actually found on FINRA's Education Foundation site that can help some of these things. And what I distilled it from this, and this is also coming from an article that was written by John Wasik, and it's an interesting one from Forbes Media that I liked. And so we're going to talk about this. And number 1 is compound interest. Okay, let's go to the basics. What you need to know about compound interest. Most people, we really don't do the math. If you're earning interest or reaping dividends, it grows over time. We can all fathom that. Let's say you're earning, as an example, 2% interest on $100. That's not much, but it will increase over time. A savings account with $100 in it and a 2% annual interest rate would earn $2 in interest for an ending balance of that year of $102, right? Now, applying the same 2% interest rate, the 102 would now earn $2.04 in the second year for an ending balance of $104.04 at the end of that year. And so we got to think of applying that to larger sums of money over longer periods of time. Now, I know I'm coming out of the gate with a very rudimentary concept around money, but I think as we think about compound interest, we think about dividends, we think about adding to it, and it's a really important tool to remember as we talk about some of the 5 main areas around money. And number 2, and this is both topical and important always, is inflation. No, we all need to know how inflation eats away at our money. And here's why I bring this up. Inflation's a tricky one because it's not tangible. You can't touch, feel, and taste it. You only really see it when it's 2 things, right in front of you and somewhat large. And right now is a great example. Gas, you go to the pump, you're seeing it. You know that paying, $4 a gallon is somewhat normal depending on what state you're in. Mostly in California and New York, that's pretty normal. But now paying $5, it's like, okay, it's right in front of me. I fill it up every 2 weeks, and it's definitely larger than what I'm used to paying. That's how we see inflation. Now, while inflation, it's bad for those kind of things, it is good for real estate. It devours our money in other areas like cash because it's all about subtraction. And people don't think about inflation this way, and that's why I want to simplify it. If the annual inflation rate, let's just go with the annual average of 2%, but the savings account only earns 1%, by the way, that would be a great savings account right now, but bear with me in my example. If inflation is 2% and the savings account only earns 1%, the cost of goods and services has outpaced the buying power of the money in the savings account that year. Put another way, your buying power has not kept up with inflation. You spent 1% more because you only earned 1% in what the accrediting side is giving you, and the 2% is eating away at it. That's how you want to understand your delta and how inflation eats away at your money. And again, it's a hard concept because, again, inflation isn't tangible. And a quick aside, Benjamin Graham, sometimes considered the father of investing and things like that, he wrote an incredible book that most people look at called Security Analysis. It's for many the old school investor's Bible, if you will. And he was quoted in saying, the investor's chief problem and even his worst enemy is likely to be himself. And I bring this up because education has a lot to do with it. The more we try to do things ourselves in a way around things that we think we know, it's really important to find counsel, something I preach on every week, right? Find that person. No different than going to the mechanic. Like, I'm very open about this. I was not raised to understand what goes on under the hood of a car. Many are gifted in that case, and I want to partner to my weaknesses. And that's one of my weaknesses. And a lot of times money, really, it's a humbling topic for sure. But when you really peel through the layers, the reality is money means something to every person, and understanding what it means to you is really important. And specifically, these first two things of compound interest and inflation, albeit somewhat simple and widely used terms, really needs to be dissected so that you truly understand it. And number 3, bonds. Bonds and interest rates. When interest rates rise, bond prices fall. And the inverse is also true. When interest rates fall, bond prices rise. Think of it like a seesaw, something I share with my clients often around bonds. And why this is important is, and people don't want to admit this, but bonds, they kind of run the market. They're that quiet, not sexy thing no one wants to talk about. But you think about it, we talk about bonds a lot when it comes to our mortgage rates around the 10-year note. We talk about as the number one flight to safety when people are feeling a little volatile in the markets and unsure what the market's going to do. Bonds have a lot to do with the market. So understanding bonds and how they work are really important. And more importantly is, just because interest rates are rising doesn't mean bonds is necessarily a bad place. A lot of people will say that. Yes, when interest rates rise, your bond prices go down, but you can shorten your duration, and it still serves as a great diversifier in your portfolio, something we do here at One Capital Management. But we also don't just sit on our hands saying, oh, bonds is a great thing to diversify. We also want to find the right types of bonds and the right duration, meaning how long we're going to own those bonds. And that really is important when it comes to compound interest, inflation, and bonds. Those are the first 3 things I want to bring up as the kind of rudimentary foundational aspects. And number 4 and 5, get into more of the debt and markets. Number 4, you can actually save money on loans if you really go through it through lower rates over shorter periods of time. Something I talk about with clients around debt management is, let's say you have a couple credit cards. Let's say 2, for example. And you have one that's a $10,000 balance that's paying you at 5% interest rate. So you're paying 5% on $10,000. And the other card is $5,000, but you're paying 2%. Obviously, anyone listening would love those interest rates for credit cards. But most people think, okay, I have $5,000 from a tax refund. Let me just chip away at the one that's $5,000, but you're only paying 2% on that. We need to focus on the interest rate first. The higher interest rate over time has much more of an ability to be able to save you. Even though you're not going to pay the full balance off, you're going to pay the larger interest rate, almost double the interest rate in my example, first. And that matters to help save money. So understanding debt strategies is also very important. And, on the debt strategy, I think the rule of money and wealth is really important when it comes to debt. We all can carry debt, and there's good debt and bad debt. I've talked about this a lot on the show. You can go back to previous episodes, and I talk about this a lot with clients, is leverage or debt isn't always a bad thing. It's just you need to use it for a purpose. For example, taking leverage for an asset may make sense. Taking leverage or debt for a depreciating asset may not. The rule of money and wealth, I think, is very simple. Don't buy a $500 wallet to have nothing in it. Buy a $75 wallet and put $425 in it. Don't go broke trying to look rich. And debt nowadays has a lot to do with that. So being mindful of the perspective you have on debt matters a lot. And the 5th item I want to bring up of the top 5 questions, and this is, again, a generic question mark that I've kind of built together and summarized over a lot of client discussions. And in this last week, especially last week on our episode talking about the 6 reasons to stay invested, I thought it might be good to talk about 5 good questions to ask yourself and educate yourself on, or find an advisor to help you with around money in general. And the 5th and final one is, when investing in stocks or bonds, diversify. There's often better returns and lower risk in investing in large pools of securities than just going and harpooning one stock. Now, past performance will never reflect future gains, but you can look a lot out there around diversification. I know it's an overly used term, but it matters. With a single stock, all your eggs are in that one basket, right? If the price falls when you sell, you lose money. In a diversified portfolio that invests in stocks and bonds of companies across the world, really, both domestic and international, you lower the chances that a price decline for any one single stock will impact your return. I should also add here, when it comes to stocks and bonds, and just maybe one other item here, is around cash. I think it's important to know how cash works in your overall plan and how you should perceive it. Largely talked about now during inflationary time periods, right? Cash is not a great asset class, but we still do want to have an emergency fund. As a certified financial planner myself, we go through the board standards, right, of a 3 to 6 months of cash reserve for your overhead. What does that mean? You can look at it from a standpoint of PITI, principal, interest, taxes, and insurance. I'd also add in your overhead for other things like food, stuff that you know you're going to need. If your overall overhead every month is $5,000 to basically wake up and live and sustain yourself, you should probably have somewhere between $15,000 and $30,000 in just a cash reserve. So for those sitting there right now with $150,000, $200,000, $300,000 in cash, really understand your cash reserve need, and then you might want to make sure that the rest of that cash is working for you. Now, that's not a blanket statement for everybody to just go on and act on, but really talk through that with your advisor to make sure that you know how much cash you should have and how much cash you should be investing. And in a summation here, and to put a bow on this week's topic, on the dovetail of last week, 5 key areas to really understand as it relates to everything we're seeing topically in the world of understanding compound interest, going back to the basics here, right? Understanding compound interest, understanding inflation, understanding bonds relative to interest rates, understanding your debt, and understanding investing in stocks or bonds and diversifying. Once you learn how to spend your money to make more money in a lot of those categories, becoming wealthy, and again, wealthy is a matter of perspective for each person, but becoming wealthy is just a matter of time. And time is really the key thing that I think everyone should know about when it comes to investing and overall money. The sooner you do it, the better. Time is your best friend. Now, something I've said often, and I'll end with this, is it's not about timing the market, it's about time in the market, which has a lot to do with our conversation last week around looking long-term, looking through the window here as to what we're seeing around the world. We are doing that for our clients. I do hope anyone listening right now is actually making sure they're having conversations with their advisor. We like to make sure we reach out on quarterly calls, quarterly discussions, perspectives that we like to write. Staying in communication around world events like what we're seeing is vitally important. And I wanted to spend this week a little bit on touching on some of the stuff we saw in the past week with regards to the conflict in Russia and Ukraine, the State of the Union address. Again, it wasn't to be political, it was just to kind of give a perspective on what we're seeing, future forecasting out into the world of 2022 and beyond. And then talking about some of the basics of compound interest and inflation and bonds and debt and the market and how those things matter. And to find out more about us or more on these subject matters, you can go to our website at onecapitalmanagement.com. I want to thank you for listening to the Make Your Money Matter show. And before acting upon anything discussed today, remember, speak with a financial advisor near you. And if you're not sure where to turn and you'd like our help, you can visit us at onecapitalmanagement.com or give us a call, 805-409-8150. And remember, always make your money matter.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.